The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Happy Thursday, guys. I'm Alex Steele here in New York.
And I'm Scarlett Fu, and we're kicking you off to the closing bell here in the U.S. Big day.
Big day, and if President Trump tells you to buy stocks, should you?
Well, today, maybe.
That is the question, and you know what? Markets are following that order. You're taking a look at the S&P up 1.2%. I want to point out that it's kind of like we're back at the beginning of April across all asset classes, Scarlett. You got the VIX, the lowest since April 2nd, the dollar up the most since April 4th, and you're seeing a nice move there in that 2-year, up by 11 basis points, Scar.
All right, a wave of risk-on sentiment is washing over Wall Street, and you see it in the broad rally in the S&P 500. The Nasdaq back at its high since late March, and the small cap Russell 2000 outperforming the big caps. Even Bitcoin breaking out of its range, retaking the $100,000 level. And at the center of it all, President Trump urging investors to go out and buy stocks now. And the reason, the first of what he intends will be a long line of trade deals. The president today announcing a trade framework with the UK, concepts of a plan, if you will, before the start of negotiations this weekend with Chinese officials. Now, Trump claims that if these talks go well, tariffs on China could be lowered. But JP Morgan Asset Management's Kelsey Barrow warns against counting on too much, saying a UK deal doesn't begin to seal a deal with China.
Maybe this is good news. I'm not necessarily sure it's a roadmap for the rest of the world. And really what will be driving sentiment in the market as we turn to the next week will probably be more likely the negotiations with China.
And all of this unfolding with corporate earnings continuing to roll in after the closing bell. We've got another list of names that span across sectors, from Expedia and Coinbase to DraftKings, Lyft, and Pinterest. And as always, the focus remains on whatever they can say on their outlooks, even as numerous brands have lowered or even outright withdrawn guidance due to uncertainty over tariffs. Now, one company that is bucking the trend is Tapestry, the handbag maker raising its annual outlook, shrugging off worsening consumer sentiment, and dismissing tariffs as immaterial on its bottom line. And Alex, if you look at markets right now, tariffs don't seem to be worrying a lot of people.
Or just maybe removing that macro headwind on the margin really wind up helping equities. And this is a chart that just shows what that looks like. It's the NASDAQ 100 plotted against the 100-day and 200-day. The blue line is 100-day moving average. The yellow line is the 200. And you can see here we are kissing right now that 200-day moving average, up 18% since that low that we hit on April 8th, right before the reversal in part of Liberation Day. Plus, you got the potential of a golden cross here when the shorter term moving average actually moves, longer term moving average, I should say, goes above the shorter day moving average, and that tends to be a bullish signal. The question that I continue to have, though, Scarlett, A, is this driven by tech? And B, is it driven by fundamental real investor buying? Or is it driven by fund buying, like the volatility control funds that need to sort of re-rate as volatility falls? They go in and they have to buy stocks. Charlie McGilligan over at Nomura was saying that you got lots of money that's going to have to come into the market just this week alone on those funds buying.
All right, good questions, and we'll pose them to John Belton, portfolio manager and managing director for growth portfolios with Gabelli Funds. John, I know you heard what Alex said, but let me just rephrase it. How much of the recovery that we've seen from the lows in early April is driven by fundamental investors buying because they see good prospects out there versus momentum chasers?
Yeah, thanks, Scarlett. I think the way I'd frame the answer to that question, so first of all, let's take a step back. Since the start of the year, the S&P 500 down about 4% last I checked. S&P 500 2025 earnings estimates are also down about 4% since the start of the year. So earnings estimate revisions have coincided with the market's performance year to date. So that's kind of point one from a high level. There is fundamental dynamics behind the way the stock market has moved since the start of the year. I think to your other question, just within the last month, I do think we are coming off an earnings season that was definitely better than feared, and I would say outright good. I think we saw earnings estimates, they were being revised lower, and then through earnings season, that negative revision stabilized. A lot of positive themes we heard about from earnings, both on the consumer and the business side of the economy. But again, I think the bear case is that what we just heard from 1Q earnings season is backward looking, and the tougher times are still ahead.
So based on that, if I went back, though, say throughout April, and I look at the movement that we've seen in the equity market, and that counts for earnings, it's industrials and it's technology that have led, right? Which is a head scratcher for me. Do you think that tech still leads the way, or do we broaden out here?
Tech led the way down, and it's led the way up. Again, I kind of come back to were the earnings estimates being positively revised. It's interesting that industrials and technology led the way. I mean, I think there's actually increasingly a lot of linkage between the bellwethers in tech and industrials, and a lot of that comes down to AI. And I think a lot of what we heard during the earnings season, particularly against a market backdrop that had become very concerned about slowing AI investments, all of what we heard during this earnings season was that story is very much on track. So, yeah, I think those are still good sectors. The strongest companies in those sectors, I think, can still be good stocks moving forward.
So I like that idea, the linkage between industrials and tech. Which sector is better positioned, though, right now, given what we've seen so far in April?
I think it's case by case. I also think it depends on what kind of time horizon you're talking about. I mean, I do think a lot of these big tech companies, again, they led the way down. They got down to historically low valuations for a lot of these names, talking about the names like Microsoft, Amazon, Meta, Google. And then we go through this earnings season where they print these really strong results. Double-digit revenue growth, in many cases accelerating revenue growth. In Microsoft and Amazon's case, a kind of new story on public cloud, like a re-acceleration in core cloud migration activity, improving cloud margins. So I still think these mega cap tech companies, it's been a tough year for many of these. I think only 2 of the Mag 7 are positive year to date. I still think those are decent holdings to own through the cycle.
Which ones would you be adding to right now?
Well, I do still like Amazon a lot. I think there's clearly tariff risk. I think that has gotten into the price. But I think with Amazon, you've got a really interesting margin story for their retail business. That is still playing out. I think the earnings they just had show that is very much on track. And then you've got AWS accelerating. So I like Amazon and Microsoft being another one. Coming off one of the best Microsoft earnings quarters that I can remember in several years. And I still think that has room to run. I think it's still at a reasonable valuation for a dominant company, growing revenues double digits, expanding margins. So I think that's still a very good story as well.
These are good stories, but then you have the macroeconomic environment in which there's been a lot of weak soft data, the survey data, the sentiment data. It hasn't yet translated into weakness in the hard data, which usually lags behind, and we know that. But at some point it will, and maybe the second quarter earnings season will be a reality check for everyone. In the meantime, how do you move forward in terms of managing risk?
Yeah, I'm very cautious, I would say, in the current environment. And I think to your point on soft data versus hard data, we saw soft data take a big leg lower in kind of the February, March timeframe. Historically, a roll in soft data has typically taken 3 to 4 months to translate into deteriorating hard data. So I think, we're still at a point where a lot of the impacts of the policies that have been put in place, they shouldn't be showing up yet. It's still going to take a couple more months for these things to really start showing up in the economic data. So I still think we're in for some turbulent times ahead. I think this summer is when you could start to see some of this softening soft data translate into softer hard data. And so that's sort of what we're prepared for. Back to the tech thing, I mean, I do think a lot of the tech companies have business models that should be more insulated from the economic cycle. Again, case by case, but just one more point to make.
Is the strategy going to be buy on dips, hold on rips?
A lot of people like that moniker in this market. It does feel like a bit of a trader's market right now. We're in a market where, every day we're hanging on the next headline, and the next headline is driving the market up. But ultimately, that's really not my mandate. Is longer term, sticking to fundamentals, and so it's not really what I'm doing. But I do think we do feel to be in a bit of a trader's market right now.
All right, John Belton, portfolio manager and managing director for growth portfolios with Gabelli Funds. Always a pleasure. And thank you for coming in today.
And I'm very excited about the first Chicago Pope as a Chicagoan.
Oh, there you go.
He's plugging his city. That's what's happening.
Had to plug it.
Thank you so much, John. We've got a lot more coming up on the close, because coming up, a major media split could be on the way. Why investors speculate Warner Brothers Discovery could be set for a big breakup soon. That is sending the stock higher in today's session.
And from expectations on Wall Street to expectations out on the farm, a discussion on how the trade wars are impacting the agricultural sector with Gerrit Marx, CEO of agricultural machine company CNH
And sticking with the trade war, we discuss what's next as we gear up for those U.S.-China negotiations this weekend. Monica Guerra will be joining us. She's head of U.S. policy at Morgan Stanley Wealth Management. All that coming up. This is The Close on Bloomberg.
Yesterday was the final day of the Milken Institute's annual global conference. You got business leaders gathered to discuss a range of topics like economic outlooks, Federal Reserve expectations, and this year how trade wars could impact investor sentiment. Bloomberg's Romain Bostic and Sonali Basak sat down with Greg Fleming, CEO of Rockefeller Capital Management, to see how he's navigating the current economic uncertainty.
There's a lot going on right now, but I have to say over the course of a very long career now, there's often been a lot that's gone on through the decades. So, right now with the administration, the new administration, second time, but new administration and some of the things they're trying to do on the tariff and on the trade side. And then you have, the Fed trying to manage the business cycle. And actually that business cycle, 4 or 5 months ago, I think they thought they had a pretty good hand on that tiller. And a lot of what's happened on the trade and the geopolitical side since then has shifted some of their thinking. And then you have, the private sector, Wall Street, but also corporate America trying to figure out, okay, how do we play in this time as well? So, yes, I think it's there's a lot going on at this point in history.
When you hear some of the criticisms of the Fed and Jay Powell about not acting, whether it's to lower interest rates as the president wants or as some folks in the market wants, and you hear the communication, which is we haven't actually seen the real impact from trade and tariffs yet in hard data. So we just wait until we get that data. Is that fair?
I think they're in a difficult spot, the Fed now, because they did have a trajectory that had been in place, and that's now shifted, particularly on the inflation side. And I think the word that they're trying to avoid the most is stagflation. They want to make sure that they don't end up with a problem on both sides, which is inflation that's increasing and an economy that's decreasing at a rapid rate, maybe affecting the employment side as well. So I think until they have a sense of where those two sides are going to settle, they are going to watch and observe the data. And I do think that from their vantage point, I want them to do that. We want them to do that. Because the scenario that would be most problematic for business, for consumers, for all of us, is the stagflation scenario where inflation does pick up from here. And because of that, they've got to keep rates higher, and they're trying to focus on curbing the inflation. And you have a slowing economy as well, which is a possibility given everything in the mix now.
So if you're faced with a choice, if the Fed is faced with a choice where they have to cut rates to save the economy or keep them high to avoid inflation, if we hit that dangerous stagflation scenario, what's the better choice?
Well, I think that it'll depend on trend lines and degree. First of all, on the economy side, on the employment side, we may be surprised, Sonali, on employment, because right now we have, I think, literally no immigration, legal or illegal. So the number of workers on that side of the equation isn't increasing. So, the unemployment rate may be slower to go up than in previous cycles. But I think they're going to be looking at, if they're dealing with both problems, they're going to look at the degree of the problem on each side. And that's one reason why I think that the data as it comes out over the next few months, which to Romain's point will be the actual data post tariffs going in place. Now, we also have to see how long these tariffs are going to stay in place. Are we going to start getting bilateral deals? Where are we with China and the conversation finally starting to happen between the U.S. and China about taking a step back here?
Did that surprise you? I mean, we had those headlines late Tuesday night about an actual formal meeting now between Scott Bessent, who was here at Milken just on Monday, Sunday and Monday, and now this meeting that they're going to have in Switzerland. Does that encourage you?
It does encourage me, and it doesn't surprise me. It's in both sides' interests. Right now, the degree of the tariffs, the level of the tariffs, basically shuts things down, and nobody wants that. We don't want that, and China doesn't want that. So hopefully, at a minimum, what they can do in these early conversations is say, let's pull it back a lot and pick a point from which you can negotiate a broader trade deal. But where the tariffs are now is prohibitive on both sides.
And that was from Bloomberg's Romain Bostic and Sonali Basak speaking with Greg Fleming, CEO of Rockefeller Capital Management at the 2025 Milken Institute Global Conference. Now, coming up, we're going to break down Warner Brothers Discovery's earnings and some reports about its cable networks, perhaps a split up coming soon. Peter Supino, Managing Director and Senior Analyst of Media and Entertainment at Wolfe Research, joins us next. This is Bloomberg. It's time now for our top calls that look at some of the big movers on the back of analyst recommendations. And we'll start with Uber. Wedbush shifting its rating down to neutral from outperform while slightly raising its price target by $5 to $85. The firm says Uber shares have appreciated considerably over the past year, but that the ride-hailing company faces a lack of catalysts in the near term to drive its stock even higher. The shares down about 0.9%.
All right, looking at shares of Coty, Deutsche Bank cutting their recommendation on the beauty company to hold from buy, trimming their price target $2 for a total of $6. Deutsche Bank warning that the outlook isn't so rosy for Coty, saying the company's weak third quarter earnings, slowing growth, and tariff turmoil are all challenges that lay ahead. Shares, however, are up almost 6%.
And finally, AMD. DZ Bank upgrading the chipmaker to buy from hold with a price target of $118. This in the wake of the company reporting beats across its first quarter results and 2Q outlook, coupled with President Trump's announcement to rescind global chip curbs. The move would reduce policy-driven revenue risks for semis in the near term. Shares of AMD up about 2.7%. And those are some of our top calls.
All right, another stock we're keeping our eye on today is Warner Brothers Discovery. The media company reported revenue for the first quarter that missed expectations. Despite this, shares are up over 5% on reports that the company is moving towards splitting off its linear cable networks. Joining us now to discuss is Peter Supino, Managing Director and Senior Analyst of Media and Entertainment at Wolfe Research. Peter, this sort of follows what Comcast is also doing. Was this a surprise to you?
No, it's not a surprise to us or any of the analysts who follow the company closely. In December, Warner Brothers announced that they would reorganize the company so that they could pursue any number of potential restructurings, acquisitions, divestitures, different strategic paths. And so these rumors aren't new, and eventually something will happen here.
So you list off a couple of possibilities: restructurings, acquisitions, divestitures. Who's going to make the first move? Which company is likely to make the first move in order for all these things to fall into place?
Well, the great thing about being a Warner Brothers shareholder, and we have a peer perform or a neutral rating on the stock, but the great thing about owning the stock is that one transaction seems to be under management's control, and that's splitting up the company into its two key and very unrelated at this point constituent parts. And that's on one half streaming and studios. It's HBO, it's the Warner Studio, it's Max, the things with secular, stable and in some cases growing secular or long-term dynamics. And then on the other side of the house, the linear TV networks business is in what seems to be an inexorable decline. And these two businesses have drastically different costs of capital, really different opportunity sets, and they're not very complementary at this point. And so if the company were to split in two, the stock could be up quite a bit.
How do you value what would be spun off, like the cable networks? What's the value there?
Sure. The cable networks are the businesses that thrived on the back of the linear TV bundle that we all grew up with. And that portfolio is worth a really low multiple of really high free cash flow. So the publicly traded comps you might look at are Paramount, Fox, AMC. On the other side of the house, the streaming and studios business has really flattering comps. There are very few publicly traded movie comparables, and Netflix and Disney are probably the two best comparables among the streamers.
Once Warner Brothers Discovery does split, would it be a buyer or a seller?
So the portion of Warner Brothers Discovery that is streaming and studios is probably agnostic to being a buyer or a seller. The key is scale. And they would love to combine themselves with a greater amount of engagement, whether it's a commercial deal or a merger, so that they're stickier for consumers who inherently churn a lot as streamers. And then on the network side, Warner Brothers would be a very natural combination with Comcast's SpinCo, which yesterday they announced would be named Versant.
Right, for sure, Versant. I don't really know what that means.
I don't know that we need to know what it means.
That's a great point. Hey, Peter, you also cover Paramount. You have an underperform rating on that. We get Paramount earnings after the closing bell. What are you keying in on?
Well, at Paramount, the first, second, and third thing to watch is always the rate of decline of the linear TV business, because it's heavy duty at Paramount. And as storied as the Paramount Film Studio is, it just doesn't generate very much cash flow in proportion to those linear TV networks.
Right, and that's been the story all along. Yet there's a lot of expectation that this deal with Skydance Media is, everyone's waiting with bated breath to see if it gets done, whether the FCC jumps in and raises its hand and says, wait, hold on, we need this to happen or that to happen. And a lot of it will depend on whether there's some kind of settlement with the lawsuit from President Trump against CBS. Do you think that this is something that CBS would announce or Paramount would announce in an earnings call?
It's unlikely that they would announce that they'd received a green light from the government in an earnings call, because the process with the government would clearly be unrelated to the earnings cycle. And then as soon as the company had an update, as soon as Skydance had an update about its ability to proceed, they'd be informing the market. It's in everybody's interest to move along. It's bananas that we're even talking about this, but here we are.
What about ad revenue? What are we going to learn? What have we learned, actually?
So a month ago, we were very much braced for pain in the ad market. And remarkably, the ad market seems stable. The whole U.S. economy seems to be just waiting, but continuing to trade. And ads are no different. And Warner Brothers Discovery Today, which has a lot of the same secular troubles that Paramount has, said that macro's okay.
Right, which we've heard a lot from different companies. Like right now it's okay, TBD, what it looks like later. Hey, Peter, thanks a lot. We really appreciate it. Peter Supino, Managing Director and Senior Analyst of Media and Entertainment at Wolfe Research. And we'll be breaking Paramount as it comes out after the bell. That stock up by about 0.8%. Morgan Stanley also saying that Paramount has above peer exposure to linear TV headwinds and some financial leverage as well.
All right, so we'll be keeping an eye on those. One thing I didn't get a chance to ask him about is this idea that Max is going to start cracking down on password sharing as well, in the same way that Netflix does.
Which helped Netflix quite a bit.
So you wonder if that's going to be something that will show up in the next quarter or two, or if that's kind of down the road.
Yeah, absolutely. All right, coming up, we're going to speak to the CEO of CNH, Gerrit Marx, about the company's investor day and get his outlook on the ag sector amid a global trade war. This is The Close on Bloomberg.
The deal includes billions of dollars of increased market access for American exports, especially in agriculture, dramatically increasing access for American beef, ethanol, and virtually all of the products produced by our great farmers.
We've got about 30 minutes to go before the closing bell. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. And that was U.S. President Trump talking about a trade framework with the UK. Scarlett saying that the UK deals offers $5 billion in export chance for ranchers and farmers, providing a potentially really nice relief valve for earnings there.
Absolutely. And American beef being sold to the UK. This is something that the beef industry was certainly looking forward to. There's a lot of stuff that they had to still work out, though, because the UK had some concerns on their side. But for now, at least the framework seems to indicate that they've smoothed that over.
And machinery is also wrapped into that. So joining us now to discuss on the heels of their company investor day in New York is Gerrit Marx, the CEO of CNH, which is the world's second largest manufacturer of agricultural equipment and technology. Gerrit, it's a real pleasure to get you on set. Thanks for joining.
Thank you very much for having me on your program.
So we'll get to the investor day stuff, absolutely. But what's your first blush for having this trade deal with the UK in terms of the availability of product exports?
Well, look, I haven't really seen the details yet because I had my investor day whole day. So I got a bit of pieces of information from left and right. But it definitely adds to certainty, and that's what we need. So it's a first step, adding certainty to a lot of uncertainty at this point. So it's a good news. 2025
was sort of shaping up to be a cyclical trough, but then you get the tariff headwinds and question marks. What do you think? How long does that either extend or shorten this cyclical trough?
We need to see. I mean, I would expect over the next couple of quarters to get more clarity and certainty through these bilateral deals. And I think certainty is what our farmers, what our customers really need, because they need to figure out what they're going to plant next year to see what is going to be exported from the U.S. But this deal is a pretty good first step, and I hope that there are many more to come that add certainty to our farmers.
Tell us a little bit more about what you're hearing from your customers, from farmers specifically on tariffs and all the trade uncertainty that they've had to really try to work their way through so far.
Yeah, look, well, just last week we spent in Nebraska, the whole board and the global leadership team of CNH Industry, we spent a whole week in Nebraska, not only on the board meeting, but also meeting customers, meeting farmers, meeting dealers. And I think the uncertainty is pretty much around rising input costs, like fertilizer, seeds, et cetera. So those things become more expensive. But on the other side, it's a certain uncertainty. Where are they going to sell their products in the future? Because there was quite a decent amount of soybeans being exported from the U.S. to China. So how does that add up now? And I think it's on top of the administration's mind how to support farmers, not only with a support package, but also with trade deals.
Absolutely. What's your level of concern on a scale of 1 to 10 that you could lose permanent market share in crop exports, especially to China, something like China, which you just mentioned, soybeans to China?
Well, I mean, I think it's a pretty considerate concern that exports in the ways how we have seen them in the past decades to happen won't happen in the future. I mean, China has already made their choice to source certain commodities from South Americans and other parts from the world. I don't think that this would change anytime soon. I think there will be a new market needs to be opened up for the North American farmers for export to some extent, and for domestic consumption and domestic demand. I mean, ethanol as part of fuel is one element that might add to it, but let's see. I mean, there might be some pretty interesting ideas in play.
Part of what you talked about on the Investor Day was investing a lot in precision farming solutions. Where do you see the biggest opportunity to drive margin improvement there?
Well, the precision is a tool that makes the life of the farmer much easier, more predictable. It helps the farmer to make more informed decision on when to plant, when to harvest, and these types of things. But there's also a whole farm management system that is now coming up that helps the farmer to basically run the farm like a company, like with different systems around it, and that overall will make the business more predictable, and will make it leads simply to better informed decisions. So I think precision is playing on the ground with autonomous driving, guided auto guidance, but all the way into the way how the farm is operated and managed and the commodities are being sold. So there's a lot more to come from the precision side, and that will ultimately drive our margins as well as the farmers.
That being the case, how do you plan the pricing for these kinds of precision farming products? Is this something where your farmers will need to pay for the product up front, or would it be done through some kind of subscription model?
Well, we are going into factory fit solutions, and we're going into basically ex-factory fitted technology as well as...
What does that mean?
Ex-factory means like the farmer, they order the machine and we fit technology into the machine, X works. So when we build it, it is already equipped. Then we have retrofit. This is the second kind of technology add-on way. This is a new machine that sits in a dealership that gets customized in the dealership in a retrofit. And the third element is the aftermarket portion, where you basically put this type of technology on a machine that is like 5, 6, 7, 8 years old, and you kind of upgrade it there. We are looking into options to go into run rate businesses, like subscription-based businesses, but we have learned from our farmers that it's not what they really like. They do not want to have certain payments made in light of uncertain weather and uncertain trading conditions.
Right.
So overall, net, I think subscription is an interesting angle, but we're not pushing it very hard.
You talked about mid-cycle operating margin in your ag business by 2030 to hit between 16 and 17%. What's your biggest lever to get there?
Well, we have certainly further opportunities on the cost side, on the efficiency side. We are deploying AI across the company to automate several processes. And I think one area that we have highlighted today during the Investor Day, which resonated really well, was our collaboration and our partnership with the dealers, with our network. We have two very, very strong brands, New Holland and Case IH, and we have been operating them through two very distinctly different networks. And by merging those into multi-brand dealer networks helps us to focus our network partners way more on where the competition really is. And the competition for us is mainly green. And another area, lastly speaking, is quality. And I think by upgrading our product quality tremendously, we have better net price realization on new machines, used machines. We spend less on, let's say, cost of non-conformity or non-quality. And these are like all areas that will add to a better marginality by 2030.
So that 16 to 17% mid-cycle operating margin, is that target weighted to the back half, or is it linear?
It's pretty linear. Some elements that we have in there, like sourcing, are pretty steady across. We have some elements about product launches, like tractors and combines, that is coming rather at the earlier part of that cycle. While on the quality side, while we do see already pretty good improvements coming, it has to wash through all the machines that we already built, because, let's say, 2/3 of the quality outlay, quality cost outlay that we have is on the machines that we built the last 5 years. So we got to wash that through, and I think over time, that quality piece is rather back-end loaded. Net across all buckets, it's pretty linear across those 5 to 6 years.
Last question here is circling back to the trade talks too. What is your outlook for your business in China? I mean, for you guys, it's really like US, China, Canada, Mexico. How do you feel about your relationship with China right now?
Well, our business in China is pretty small.
Okay.
We have exported mainly large machines from the United States to China, which we have stopped, obviously, for the reasons which are quite obvious. We have sourced a few things from China to the US. We are now in the midst of actually resourcing those components. We have already, one large component is our engines that we are getting for our machines. Those machines components will come from Europe as a next step, and then let's see, maybe there's another step to come. But we are resourcing, we are realigning our supply chains quite a bit. And I think importing machines from the US to China is something that is not going to happen anytime soon as we speak.
Gerrit, really appreciate your coming in. Thank you so much for joining us today.
Thank you very much.
Gerrit Marx is the CEO of CNH. Now, coming up on the close, we're taking a look at shares of Coinbase up more than 6% after the company announced a new acquisition before it reports results later on today. We're going to discuss in today's Stock of the Hour. Next, this is Bloomberg. Shares of Coinbase up by more than 6% after the company announced it will be acquiring Deribit. This is the world's largest exchange for Bitcoin and Ether options for $2.9 billion. All of this as the company prepares to release results after the closing bell. Joining us now to discuss is Mike Regan. He is global team leader for cryptocurrencies at Bloomberg. So, Mike, put this into context for us. What does this acquisition do for Coinbase?
Well, it's a pretty big expansion, Scarlett, for them in the crypto derivatives market. Now, Deribit's not exactly a household name in the U.S. for one good reason, is that they are not available in the U.S. Because of the sort of harsh regulatory scrutiny of crypto in the past administration. There was just really no Bitcoin and Ether options trading allowed. So this is an international exchange, but internationally, globally, crypto futures and options are really a huge market and considered a very lucrative market for exchanges like this. So while this is, part of Coinbase's international offerings for now, I think it's safe to assume that there could be some optimism that in the Trump administration, that some of these barriers that prevented crypto futures and options from trading in the U.S. Have a decent chance of coming down in the near future. There's already been talk about allowing what are known as perps, which are perpetual futures, sort of a crypto market invention that are insanely popular globally, really kind of the tail wagging the dog when it comes to the crypto markets around the world. So, a pretty bold step for Coinbase to make this acquisition and expand into this derivatives market.
Will it face, scrutiny from regulators overseas? Will they, say this is a little bit too much?
We'll have to see. I would be surprised if it faced too much scrutiny. This is a private company being purchased by a U.S. company. I'm not sure other regulators are in the mood to pick a fight with the U.S. these days, given Trump's sort of pugnacious stance towards other countries. But it's a good question. We'll have to see. But I haven't yet heard of any concerns about global regulators with this deal.
Hey, Mike, we get Coinbase reporting after the closing bell today as well. What are you going to be looking for?
Well, they're expected to post a pretty good increase in profit. One thing I would say about Coinbase's earnings is they tend to surprise analysts by huge amounts, double, triple digit percentage surprises. So you have to look at all the estimates on this company and take it with a grain of salt. The markets are volatile, and so is sort of that earnings as far as what they do compared to expectations. But, it was a pretty strong quarter for Bitcoin. We saw that record early in January and then it dropped. So the volumes were pretty decent. So it's all about volume, obviously, for Coinbase. So certainly expecting, I think, something like a double in earnings per share profit compared to last year.
Okay, so good to watch out for. In the meantime, you look at shares, the price of Bitcoin above $100,000 once again. What's been the tailwind here?
I think two things, Scarlett. Obviously, the stock market's doing well, and Bitcoin tends to have an on and off correlation with the stock market and that risk on mood. I think, both being sort of in the risk on category right now. I also think there's so many companies coming out and trying to emulate the success that Michael Saylor has had with the stock price at MicroStrategy, now known as Strategy. We just a couple weeks ago heard that a SPAC sponsored by Cantor Fitzgerald is coming and basically trying to emulate that exact same strategy, as many companies are. Simply set up a public company to buy Bitcoin. So I think that's been a good tailwind for the price.
Hey, Mike, really great stuff. Good reporting. I'm Michael Regan, the global team leader for cryptocurrencies. We're right here at Bloomberg. We're about 15 minutes away from the closing bell. We'll take you right to it. This is The Close on Bloomberg. Some breaking news for you. President Trump proposing a tax hike on some of the wealthiest Americans who earn $2.5 million or more. Joining us now to discuss is Bloomberg's Balance of Power co-host, Kailey Leinz. Kailey, what do we know?
Well, according to our reporting, Alex, the president actually made this request directly to the Speaker of the House, Mike Johnson, yesterday, that the upper tax bracket, which currently stands at a high of 37%, be raised to a tax rate for those making $2.5 million for a single person or $5 million for a couple to 39.6%. This is something that could be a hard swallow for the Speaker, who has previously suggested that the Republican Party should not stand for any tax hikes of any kind. Instead, what they're pursuing, of course, is tax cuts. But what the White House is looking to do here is to raise money to pay for the tax cuts they'd like to see elsewhere. Keeping in mind, the president has made a litany of promises on taxes during his campaign and since, not only to extend his 2017 tax cuts, but also to implement new cuts so that there's no taxes on things like Social Security and overtime. For example, he wants to have tax breaks as well for interest on things like auto loans. All of that could add up to a price tag of well over $4 trillion, and there's going to need to be offsets to pay for that. Keeping in mind that, of course, there's also the spending cuts part of this conversation that the House is really struggling with right now, in particular when it comes to Medicaid, which is where a lot of those savings were intended to be found, more than $800 billion worth. But that is something that is highly politically sensitive. So it's not clear whether or not this could actually fully work its way into the budget reconciliation that is currently underway on Capitol Hill. But 39.6% is the high end of the rate the president and the White House are looking for here. And it's not just that. He also, according to our reporting, reiterated to the Speaker his desire to eliminate the carried interest tax break. That, of course, is something that venture capital and private equity care very much about. And that is something that also could be hard to swallow here, as these committees that are really going to deal with this, the House Ways and Means Committee as well as the House Energy and Commerce Committee, are looking to mark up their parts of this legislation that would, in theory, contain these policies on Tuesday next week.
All right, Kailey Leinz, thank you so much. As you and I were just discussing, Republicans raising taxes, it's like anathema.
Yeah, it's
unheard of.
Doesn't quite make sense.
In any case.
Yes, exactly.
Trade deals
moving the stock market, but we are off the highs. You just take a look. We're seeing some selling into the close here. The S&P still up 0.7%, but a far cry from the over 1% that we saw. So you could definitely see maybe some funds selling into the close. Outperformance still from tech, Scarlet, industrial, still the best performing sector within the S&P. Even the Russell, not to be left behind, up by 2%.
Yeah, plenty of green for investors to choose from today across the major indexes. For more market analysis, let's welcome Aoifinn Devitt. She is senior advisor and market strategist at Moneta. Aoifinn, thank you so much for joining us. We are in the trade deals part of the cycle right now where we're waiting for any kind of announcement, and there's a lot of anticipation built up with regards to this weekend's conversations between Chinese and U.S. officials in Switzerland. What is your level of concern that there's an overpromising, under-delivering situation going on?
I think we can see that in the market's reaction today, even the fact that they pull back just in those numbers you cited. There is a sense of asking questions later. And I think that perhaps the market was a little overly enthusiastic. And when you actually parse the UK-US trade deal, you can see that there's not a huge amount in there, a little bit around agriculture and Boeing in the case of the UK, and a little bit, and then of course around steel and automobiles in the case of the US. So I'd say that it's actually very little has been achieved in this trade deal, but yet it has been a big bang announcement. So that's exactly where the overpromising can come in. We know from the lesson with the Japanese delegation that 3 days could go by of negotiations without any real success or milestones reached. And there's a lot hinging now on the Chinese discussions happening in Switzerland. So I'd say that there's a lot of expectation built into that. We can see the way the markets react. They barely reacted at all to the Fed decision on Wednesday. And basically all eyes are on trade and tariffs right now. So that is what's moving markets. And I think there's a little bit of being priced for perfection.
Right, because we did see that big run up. So if that's the case, what do you do? Do you need to sell into rallies? Do you just need to kind of hold positions and hold your nose for the next year or so?
The year is a little bit hard to tolerate, I would imagine, but certainly it's very difficult. We've looked at some of the volatility in the S&P with our clients over the last, say, month, and the intraday volatility has been stark. The volatility within sectors has been extreme, and we never recommend market timing, but we think it is particularly difficult to get right, both on the entry and the exit today. So yes, holding one's nose certainly in the short term is essential, but when it comes to rebalancing, I'd say being very disciplined about that. The tax loss harvesting was a big theme during the downturn. And we can just be more disciplined than ever when it comes to re-upping into the areas that have underperformed. But I wouldn't say any kind of general long and hold position is appropriate just at the moment.
How would you look at the U.S. relative to other markets? And I think about how, for instance, the Bank of England is cutting rates. The Fed has made clear it's not in a position to do so in the near term.
This is the new form of U.S. exceptionalism. They're exceptional when it comes to interest rates. It seems that the U.S. is more preoccupied with inflation, with the slowdown and the effect of tariffs than other countries. We can see a very confident leaning into monetary easing coming out of the ECB, 7 cuts, out of the Bank of England, 4 cuts out of 7 meetings, clearly signaling they will do more. They know that is now their tool that they need to use to get these economies going. I think getting the economy going in the U.S. could be kind of a double-edged sword, given we know how much inflation is perhaps priced in. And even just look at the dispersion between the pump price of gas and the actual oil price today. The pump price has not fallen to the same degree. So I'd say that that's a question mark. Why has it not fallen to the same degree? Has the supply chain become expensive? Or is it that there's a stockpiling or essentially a caution in place between passing on some of these price cuts? So we're not seeing that inflation being dragged down by energy. So the Fed is cautious.
Yeah, I'm waiting to delve into that question, the oil and pump prices. Absolutely. The other head scratcher is the dollar hasn't re-rated to the same way that, say, equities have since April 2nd. Has the dollar found stability or not at this point?
I don't think it has found stability yet. We did see that it was not behaving as we would normally expect it to behave when there was, say, a rally in risk assets. It is probably because of the technical factors affecting that general flight away from U.S. safety assets, whether that be the greenback, the dollar, or the U.S. treasuries. Still not that same demand there. We know that in this game of chess that's been played around trade deals, a lot of other trade deals are being cut. And with Mark Carney being in the White House just a few days ago, we know that that's very much at the top of his agenda, is leading with Canada's strength. So all of this is likely to probably lead to a less demand for the dollar.
Aoifinn, we really appreciate Aoifinn Devitt, Senior Advisor and Market Strategist over at Moneta. Taking a look at the S&P now down, up by 0.6%, but well off the highs of the session. We're definitely seeing some selling into the close. But Scarlett, you take a look at, say, who's doing the buying. Charlie McGilligot, I mentioned earlier over at Nomura, says $25 billion in equities will be bought from volatility-controlled funds just this week. They're no longer a source of supply, but demand, and that can make a difference on the margin.
Absolutely. And people are, I think most fundamental investors are saying, I got to hold back because I have to see what's going to happen. And we know that trade deals don't come together after 3 days or 3 months of talks. They often come together after, 3 years of talks.
And reticent to chase, it seems like. They're reticent to chase, especially as valuations have crept higher. All right, we're moving you closer to the closing bell here. You got the S&P up by 0.6%, the NASDAQ up by over 1%. The VIX, though, still under 23. We have a full market coverage for you on a simulcast right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
about 2 minutes away from the end of the trading day. I'm Alex Steele alongside Scarlett Fu. We're going to take you through the closing bell in a global simulcast. We're now joined by Tim Stenovec, Carol Master, and Romaine Bostick are both on assignment today. Reed getting on a plane and coming back to New York, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. We are seeing some lightness into the close here, Tim.
Yeah, and look, if we think about crucial moments of the trading day, it was that Oval Office conversation or press conference we heard from the president about that framework, about a deal with the UK. He also said he would buy U.S. stocks. That buoyed stocks, but like you said, we're seeing a little air taken out of the trade as we get to the close.
Yeah, I was looking at the IMAP earlier, and it showed that it was an incredibly broad advance with 10 out of 11 sectors in the green. That has changed a little bit here, but worth noting still that those sectors that are lagging behind, healthcare, utilities, real estate investment trusts, they tend to be a little bit more defensive, whereas the ones that are leading the gains, consumer discretionary, industrials, energy, definitely more cyclical.
Yeah, interesting to take a look at other areas of the market, right? You're seeing a pretty solid selling all across the yield curve, guys, particularly in that front end. Yields really moving higher, the highest since April 11th. So we've definitely re-rated most asset classes back to where we were around April 8th, 9th, 10th, once we sorted out post-Liberation Day.
Some even higher than that, like Bitcoin, for example, up another 4.6%, $101,000 on Bitcoin right now. Remember that all-time high was January 21st, more or less, about $112,000 per Bitcoin.
Yeah, a lot of people talking about how maybe we would break out of our range. And yes, we are right back to right around that April 2nd level, just around it. But in order to really break out, there needs to be more concrete details of what discussions are taking place on trade.
You know who's been buying? Retail. Retail has been a consistent buyer within the equity market. But do you chase here is really the question. There is the closing bell on this Thursday. You got the Dow Jones up by about 0.6%, the S&P up by about 0.5%, the NASDAQ up 1%. So we are seeing a little bit of rollover as we headed in to the close here, but nonetheless, a pretty solid day on the trade deal between the U.S. and the U.K. I just want to point out small caps still participating in the rally here, guys, up by, I can't read that far, 2%? I'm going to go 2%, Tim.
I can't read that far either.
Okay, good. So it's up a certain amount.
Yeah. It's
more
green.
Than the others.
It is green. We can confirm that. Hey, taking a deeper look into the S&P 500, we did see 347 names move higher, 154 names move lower. In terms of the prominent ones that moved higher, Axon Enterprise, the maker of Taser, up 14%. A couple energy companies higher. Enphase Energy up by 12% on the downside. Match Group down 9%. Fortinet and Cencora leading losses, at least on a percentage basis, in the S&P 500.
All right, a quick mention just once again of the IMAP. You have 7 out of 11 sectors in the green, as I mentioned, healthcare, utilities, and REITs, and now consumer staples in the red.
All right, guys, we're getting some earnings out. We got a ton coming out after the bell. Lyft coming out. All right, taking a look at earnings for the first quarter, $1. They were looking for a loss of about 68 cents a share, so that's a beat. Gross bookings for the first quarter coming in at $4.16 billion, bang in line with estimates as well. Active riders also coming in a little bit stronger than estimated. Revenue, though, a little bit light, $1.45 billion. Let's get to the forecast now. Looking at second quarter gross bookings coming in anywhere between $4.41 billion and $4.57 billion. So bang in line with the range that was expected. They're also increasing the share repurchase program to $750 million. That stock up over 4%.
All right, you said we had a lot of earnings. They are coming fast and furious in the after hours. Expedia shares doing a whole lot of nothing after the company reported first quarter adjusted EPS that beat estimates. 40 cents was what came in. 36 cents was the estimate. First quarter revenue coming in just shy of estimates at $2.99 billion. First quarter gross bookings coming in at $31.45 billion. That's just shy of estimates of $31.76 billion. Once again, shares unchanged in the after hours.
All right, just jumping in here with Akamai reporting results. This is the infrastructure software company. First quarter revenue, pretty much bang in line with analyst estimates. First quarter adjusted EPS, though, is a beat, $1.70 versus the average analyst estimate of $1.57. When it comes to the outlook for this quarter, the second quarter, it has narrowed the range of its outlook here. As far as the full year revenue outlook, we're looking at $4.05 billion to $4.2 billion. Previously, it had seen $4 billion to $4.4 $4.2 billion. You look at the shares right now, currently unchanged, but we do want to mention that the CEO, Tom Leighton, will be joining us tomorrow on the close.
All right, like a deep tease. All right, also looking at Paramount Global. So revenue came in at $7.19 billion. That was down 6.4% year on year, but a little bit better than estimates. Let's get to some of the details, though, with that. TV revenue portion comes in stronger than estimated, yet still down 13% year on year. That direct-to-consumer revenue a little lighter, but yet came in stronger on a year-on-year basis. And the entertainment revenue for film beating estimates and also up on a year-on-year basis. In the press release, guys, they talked about the completion of the Skydance transaction is subject to regulatory approvals and customary closing conditions. The transactions are expected to close in the first half of 2025. Scar.
It sounds so innocent. It sounds like such boilerplate when you know that there's a lot of drama behind it.
So much drama. Yes.
All right, I'm watching shares of Trade Desk, and they're moving higher in the after hours. It's the ad tech company, up about 11% right now. Shares were up as much as 14%. The company reported first quarter adjusted EPS that beat estimates, saying that second quarter revenue will be at least $682 million. That's just a tad shy of the $682.7 million that analysts wanted to see. Second quarter adjusted EBITDA coming in above estimates, and the company sees second quarter revenue coming in just ever so shy of estimates. First quarter adjusted EPS did beat at 33 cents, and first quarter revenue did beat at $616 million. Once again, shares up about 10.7% in the after hours.
All right, let's take a look at shares of Dropbox, moving right now after reporting first quarter adjusted EPS beat analysts' estimates. We're talking about 51 cents. Analysts were looking for 62 cents on average. In terms of the revenue, $624.7 million does top the average analyst estimate. The stock, however, just down marginally by about 2% right now.
All right, I just want to go back to Lyft for a second because that stock is driving higher. I can't say that, but I was trying to make a pun. Moving much higher in the post-market. It's seeing that gross bookings is about to be on the high end about $4.57 billion. That low end, $4.41 billion. We're seeing a big, nice jump in after hours earnings and increasing their repurchase program.
And a huge contrast to what Uber reported, right? Because they reported weaker than expected quarterly gross bookings for the period, and they were citing the slowdown in the economy, a slowdown in the rideshare business, and so perhaps people were expecting Lyft to do something similar.
We have to wonder what the margins are to look at that as well, because part of the way that Lyft can do that is by competing on price, and that might hurt other areas.
Okay, I'm looking at what's going on with Wolfspeed right now. Third quarter net revenue did meet estimates. Shares, though, really moving lower in the after hours, bouncing around about 12, 13, 14% lower as we speak. Third quarter net revenue coming in just shy of estimates, ever so slightly. Third quarter adjusted loss per share coming in at 72 cents. That's shy of estimates at 82 cents a share. So that was pretty good. Third quarter net revenue meeting estimates. Looking for more headlines on why shares are moving lower. I will get those to you as soon as I get them. Once again, shares of Wolfspeed in the after hours down right now by about 11.3%.
All right, let's take a look at Sweetgreen as well. Once my favorite salad company until I decided I couldn't afford the $20 salads every day. Let's take a look at revenue for the quarter. Revenue meeting analyst estimates, $166.3 million, slightly higher than the anticipated $165.1 million. For the first quarter, it did report a loss for the period. 21 cents a share was a loss. That is narrower than what analysts were looking for. They anticipated a loss of 22 cents a share. The stock marginally higher right now, up by 1.1%.
All right, I'm taking a look at TKO. That, of course, has the brands like UFC and WWE. They raised their 2025 full-year guidance despite the fact that their first quarter earnings did miss estimates. The UFC adjusted EBITDA coming in at about $227 million, and the WWE EBITDA coming in about $193 million. The CEO in the press release saying, look, we're off to a good start. Both UFC and WWE are delivering solid financial results, guys.
All right, well, speaking of solid financial results, Pinterest shares are higher right now, and it all has to do with that outlook coming from the company. It says they see second quarter revenue coming between $960 to $980 million. Estimates were at the lowish end of that at $963.7 million. Shares higher by about 11.3%. First quarter adjusted EPS came in shy of estimates. First quarter revenue, though, came in above estimates. The company does see adjusted EBITDA for the second quarter coming in at $217 million, $237 million. That is within the range. Estimate was for $237.4 million, so just shy of that range, I should say. First quarter adjusted EBITDA did come in above estimates at $171.6 million. First quarter monthly active users, though, was higher than estimates at $570 million. Second quarter revenue, in terms of that outlook, plus 12% to plus 15%.
All right, let me just jump in here with a healthcare company or a healthcare equipment company, and that is McKesson, reporting fourth quarter adjusted EPS of $10.12, beating the consensus estimate of $9.75. Revenue also up. Revenue actually trailing the average analyst estimate, $90.8 billion. Analysts were looking for $94 billion. As for the outlook, it sees 2026 adjusted EPS of $36.75 to $37.55. Analysts were looking for $36.73, which is lower than that range. And McKesson says it plans to separate its medical surgical solutions segment. So again, an announcement here from the medical equipment company McKesson saying it plans to separate its medical surgical solutions segment.
All right, taking a look at a firm here. Shares were down by about 4% after issuing their third quarter results. Their third quarter revenue coming in a little bit better, though, $783 million. The street was looking for about $782.9 million. So definitely on par with that. We can go through the press release and bring you more details as it crosses.
That was a lot of earnings. And we're not quite completely done. We still have more companies to report. A big thank you to both of you. We can hold down the fort. We don't need Carol and Romaine, do we?
Let them enjoy their flight back from LA.
Hey, Carol's hard at work. Carol's hard at work in Arizona. They're not letting her come back.
What? She's on the West Coast.
No, I know. She's still working. She's been on like many planes. That is going to do it for our cross-platform coverage of the market close on Bloomberg Television, radio, YouTube, and Bloomberg Originals. We're going to see some of you back tomorrow, same time, same place. I think Carol gets the day off, finally.
All right, that does it for our close simulcast. In the meantime, we are going to break down more of those results and get you some insight into what they could say about the broader market's direction with Peter Tchir. He is head of macro strategy at Academy Securities. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. Let's take a look at where our markets closed out the day. The S&P ended up by about 0.5% higher, but an intraday chart shows almost the round trip. It had a big spike higher around 11, and then really sold off a little bit into the close. The selling continued in the bond market, though, holding steady with yields up 11 basis points. It was pretty similar throughout the rest of the day. The dollar up as well, up 0.6%, Scarlett, up the most since April 4th. It's like we've re-rated over the last 4 to 5 weeks. And I do want to point out the large move in crude. In just one day, we're now back above 60 for crude here in the U.S. If you get certainty on trade, if we're not going to go into global recession, if you have indicators on that end, maybe you don't need to see crude with a 5 handle.
Oh, Alex, that's a lot of big ifs.
Oh, totally. Yeah, no, I'm not.
No. But for today, it's leading to a lot of up arrows for risky assets. In terms of the earnings numbers and what they tell us about what's going to happen with individual companies and sectors, let's take a look at a couple that are on the move here. Pinterest is, of course, the company that it's a social media website, but I'm not really sure I understand how it's a social media company. In any case, Pinterest up more than 10% right now after its second quarter revenue guidance came in at higher than the estimate at the midpoint. So perhaps allaying some concern about this advertising downturn. We also want to look at Expedia, the online travel company, down about 2.8% after its first quarter bookings miss the average analyst estimate. Travel demand does appear to be softening. And Lyft shares up more than 5% right now after its first quarter rides beat analyst estimates, and first quarter EPS also topping the average analyst estimate. Lyft also increasing its stock buyback program, but second quarter gross bookings are lower than what analysts had been anticipating. So, or actually, the low end is lower than what the midpoint is for what analysts are looking for. So that gain has come back a little bit here.
Well, here's an interesting one. Coinbase is coming out with numbers right now. A total revenue coming in just over $2 billion. That's actually short of analyst estimates. Trading volume was a little bit better, but that transaction revenue was a little bit lower, as well as the total revenue a little bit lower. I should point out that subscription and services revenue coming in a little light as well. So that stock now flipping into negative territory as it trades in after hours. So the risk on wave, though, washed over Wall Street today. Stocks rising following the U.S. and UK reaching a trade framework. This comes as President Trump is urging investors to buy before talks come with China. Joining us now is Peter Tchir, head of macro strategy at Academy Securities. Putting aside the last half hour of trading for a second, we did see that spike when the trade deal was announced. Is that justified based on the actual facts that we saw?
So if you look at it even more closely, though, we kind of actually sold off while they were talking about the trade deal. The market started rallying much more during the Q&A period.
Yes.
And I think it came down to the optimism about China, the optimism about chips, and maybe those rules. So I'm kind of I'm just looking at the world right now through China, chips, and the 2026 budget. I think those are going to be the three big drivers for the next few weeks.
That's a lot of things that won't get resolved anytime soon. And in the meantime, everyone's looking at every tick of every stock price. We get a lot of earnings like we did at the top of this hour. I know that you are not someone who delves deeply into corporate earnings because you're a credit guy at the heart of it. But what is your takeaway from the earnings that you have seen?
That kind of everyone's in the same state, that they're not quite sure what the economy is going to look like 3-6 months down the road. I think some companies benefited from kind of this rush to get ahead of some of the tariffs. Some suffered. But it's been very hard to get a good read on almost anything with all this moving around. And even consumer credit. It's hard to tell what's going on there as student loans start to have to get paid. So there's this state of flux. And I think it's, I keep waiting for some companies to say they have clarity. And that seems not to be the case right now.
We're all looking for what's going to happen over the weekend in Switzerland when it comes to China and U.S. trade deals. At Academy Securities, you guys have a deep bench of geopol people, of military. Like, you guys are deeply entrenched in that. What's going to be the focus for you guys?
I'll go back 3 months ago when we were super bullish, and I think we were looking at the Trump administration to do a few things. One, kind of isolate China, pick on China, and do anything that was kind of for national security. Do it produced nationally. And by nationally, we kind of meant with our close allies and neighbors. We took a huge step away from that with Liberation Day kind of being peak pulling away. And you saw today, I think, some signs, okay, we're trying to calm things down with the UK, right? There won't be tariffs on steel. There won't be tariffs on aluminum. So you're starting to see some of that. So we'll look to see if he can just intensify the friction in and around China. I think a lot of damage has been done to global relationships. I'm not sure it's going to be quite that easy. We're looking at that. And, from our understanding of people who work directly for Trump, he's so focused on trade balances and defense spending. And a lot of that came out, I think, even today with Europe, right? Or with England. We're going to sell more and they're going to buy some Boeing planes. So that's the things he likes. So I think we're going to get a lot of those sorts of messaging. It's unclear whether they're going to get this broad deal and whether we're going to be able to turn the tables back on China.
What counts as a victory from this upcoming weekend's visit?
I think some sort of pullback, some sort of discussion. I think it's going to be difficult, though. I think both sides have gone very far. We're fighting. I think what we were saying all these good things today. Xi and Putin are out there talking about trying to realign the world themselves. So I think this is going to be tricky. I think there's a lot of issues on the table. If we can pull back to maybe to 45% tariffs, does that let trade continue for a little while? Because otherwise, we are at this risk. I think you're not going to see like empty store shelves, but we're going to have a much more supply chain constrained economy if we don't get something on the table.
But that's not something that Bessent or the U.S. Trade Representative can announce. That's something that only President Trump can announce, right?
Yeah, so I think they have to get some sort of touchy-feely. I think we're going to get some disappointment, though we've learned not to bet. If Trump says to buy stocks, what does he know that we don't? So.
That always comes up. All right, Peter, always a pleasure. Thank you so much. Peter Tchir is head of macro strategy at Academy Securities. Alex?
All right, looking at DraftKings here, coming out with earnings, reported revenue for the first quarter that missed the average analyst estimates. Revenue coming in at $1.41 billion. The estimate was $1.46 billion. Also, earnings missed a touch there. And average revenue per monthly unique payer was $108. So it's staying in line with the estimates, but down about 5% year on year, Scar.
All right, coming up, we've got a conversation with Gary Vaynerchuk, the CEO of Vaynermedia, about the impact of AI on advertising, marketing, and more. This is The Close on Bloomberg. So Apple says it's actively looking at revamping the Safari web browser on its devices in order to focus on AI-powered search engines. This clearly marks a huge shift for the search industry that really has been largely defined by Google. It also has large ramifications for brands that rely on social media and e-commerce for growth. Here now to discuss marketing and advertising in the age of AI is Gerrit Vaynerchuk. He is CEO of Vaynermedia, the influencer, the original influencer that so many of us know. Gerrit, always a pleasure. Thank you for joining us.
Thanks for having me, ladies.
So those comments from Apple came from the Apple executive Eddie Q. He made them while testifying in the DOJ's lawsuit against Alphabet. What does the rise of AI search providers and their possible replacement of Google in, iPhones and iPads really mean for brands? I mean, how would you begin to think about advising companies on how to navigate that?
Not only have I begun to think about it, we're actively talking to most of our Fortune 500 companies who overly rely on Google AdWords as a driver. Now, Google AdWords, is intent-based marketing. It's not like you become aware of something and now you want to buy it. You're typing something into a search engine. I've always argued that it's more sales than it even is marketing. But there are a lot of companies watching right now in the Fortune 5000 set that are in big trouble. A huge percentage of their business comes from search. They've got their CAC and LTV numbers down, customer acquisition cost, lifetime value. And we are in the early stages of the search engine looking like the Yellow Pages. And, and it's real, right?
So what replaces that and what's the business op?
Well, what replaces it, and listen, Google Inc., Alphabet is trying to do that with their Perplexity, but there's no scenario where Google can control as much of the AI chat search ecosystem like they have on search. What replaces it is probably a conglomerate, whether it's OpenAI, whether it's Meta, whether it's TikTok, whether it's Google or Apple. It's probably going to be fragmented. Even if Google crushes it with Perplexity, they're not going to be able to have the same stance. And so what does it mean? It means that a lot of people that have been really lazy and overpaying for their brand value on search need to understand that they're in trouble and need to start to create demand and other variables, plus start to learn how to win the SEO game in the AI game. AI optimization is about to be a whole new game. We're looking at a lot of startups in my fund and with agencies of what happens when you go to OpenAI right now and say, I want to buy wine? Well, I want you to buy winetext.com because that's my dad's business. How do I get the search engines in this? How do we get the new AI, these chatbots, to actually answer that?
So how do you optimize for AI versus optimize for search engine?
AI is still taking from the web. But if you look, AI, all the different AI agents are taking from different places. Reddit seems to be quite strong. Other platforms are getting justified. When I look at the search, if I'm looking for wine terms, food and wine, kudos to food and wine out there, they're getting scraped. So the landscape is changing, and it always changes, but this is a very big, no matter how much this great program covers it, no matter how many people like me talk about it, collectively everybody's underestimating how big of a shift is coming.
Okay, so I'm a company.
Yep.
How do I then use you guys to help me figure this out? What's your pitch?
I mean, we as a Vayner's a unique company. We're an entrepreneurial driven company that I'm building for myself to build a private equity firm on top of. So my pitch is pretty easy. I'm like, hey, I'm incentivized for this stuff to work because my economics are not actually in being a service provider for you. I actually want to do what you're doing for a living ultimately, and I'm refining my machine while I have clients. That tends to work because it becomes true. You can measure it. We have a 15-year track record of being a leader in what's emerging in marketing, right? When I was yelling that social media is going to be important as the original influencer, people poofed at that. They're like, no, it's commercials, it's search, so our pitch has been sold through. People know that we're more advanced than the holding company agency ecosystem. I think what's more important, I don't worry about our pitch because we have unlimited business development. I'm worried about executing. And so what we're spending our time on is actually being practitioners and in the trenches of being best in class in social or AI.
So let's talk about execution, because there's a big thing with live social shopping, and that's huge in parts of Asia, China in particular. Not so much here. What do you think is the reason behind that? Is it just a matter of we're kind of behind and it takes the right product and the right person to make it all blow up?
Yep.
That's it?
That's it. What's
Zucks?
Mark Zuckerberg.
Oh, Zucks. Okay. I don't refer to him as
Zucks. Shoes?
Zucks.
What is that?
I think Meta's been slow to it. They're such a leader, right? TikTok's forcing the issue. TikTok Shop is a monster. There's a startup called Whatnot that you might be familiar with that is a leader as an independent. I think eBay, I'm sensing, is starting to get its act together a little bit. Shopify, could get in that game. Google, YouTube. YouTube is crushing with TV and proper YouTube, but YouTube Live, shopping. The QVC-ification of social media is here. It's here. Meaning, you're absolutely right. When I was talking about this a year ago, I wasn't predicting anything. This has happened in China for a decade. The apps are adapting to that model. It will work. It's human behavior. It's a massive space and a huge opportunity.
Really cool. Gary, thanks a lot. Really appreciate it.
Thanks,
I learned a ton. Gary Vaynerchuk, Vaynermedia CEO, joining us there. All right, Scarlett, we got some earnings after the bell that are moving quite a lot. I'm taking a look at Lyft, for example.
Yeah, Lyft is really interesting, right? Because we had heard from Uber already giving a outlook that didn't look so good because of the weakening economy overall. But in Lyft's case, it does see second quarter gross bookings of about $4.41 billion to $4.57 billion. Analysts were looking for 4.48. So that high end does exceed the average analyst estimate.
And speaking of on the low end, take a look at Sweetgreen. That stock up about 7%. Same store sales missing a forecast. Also Expedia trading heavy as well. Read through on the consumer with those.
This is the close on Bloomberg. The U.S. and U.K. reaching a trade framework as President Trump hails the deal as the first of many more to come. Joining us now to discuss is Monica Guerra. She is head of U.S. policy at Morgan Stanley Wealth Management. So, Monica, when you think about the trade deal that was announced, and I kind of have to put it in quote marks because we don't have a lot of detail on it. It's really more a framework, concepts of a plan, however you want to call it. Is this kind of the standard that we markets and investors are going to have to go by when there's something announced?
Well, it takes months and sometimes years to get a trade deal done. So it's not surprising to me that we don't have firm details. We do have some color, though, and I think that that's important to focus on. So, for example, we understand that there's a move for the U.S. looking to right trade imbalances. So, for example, now we have access to give more exports to the U.K., as well as have, proprietary relationship on certain imports as it relates to imports and exports as it relates to aerospace. So we're going to see more of this. It's not just on that reciprocal tariff number. It's also going to include this export-import relationship as it pertains to trade imbalance. And that was highlighted in his April 9th announcement.
So while President Trump makes these announcements and his team, notably Treasury Secretary Scott Bessent and the U.S. Trade Representative Jamieson Greer, work on specific deals, you have the Republicans also looking at different ways of raising money, essentially, to offset, a lot of the tax cuts that they've been promising. And today we heard from President Trump that he's pushing lawmakers to increase the tax rates on the wealthiest Americans, those who earn at least $2.5 million, with a new 39.6% tax bracket. Is this something is he floating a trial balloon here?
I think that what's interesting about this is that they are borrowing from Democrats' playbook when we're thinking about the millionaire and up tax. So to me, that is essentially a signal that they are looking and exploring all options to finance this bill. I don't believe that this one's going to make it through. The Democrats, even when they had control of all three chambers under Biden, they couldn't get even a corporate or individual income tax increase done. This is just an indication of, I think, of how hard they're working and that they're turning over they're leaving no stone unturned, if you will. Importantly, I think this relates to the actual trade framework, is that they are going to be looking, even if it's just symbolically, to these tariffs as a way to sort of pay for or justify some of the extensions and cuts around the TCJA.
Right. And again, coming up with ways to fund everything is critical here. And something else that has also come up, and President Trump has mentioned this a couple of times, is to eliminate the carried interest tax break that VCs and private equity fund managers currently can employ. Again, this is something he's brought up several times on his own, but is there the appetite to do that among House Republicans?
I do think when push comes to shove, they're going to have to look to these sort of what we would consider more on the margins tax changes. So while we do think that the corporate income tax, for example, is going to come down 6%, you could see tax increases elsewhere. So things like carried interest may become part of the discussion in Congress, and we haven't seen that very actively yet. But other things like GILTI and FDII revenues, where there's revenues from offshore business dealings, could actually see an increase. And that is really consistent with this broader America First agenda, where they're trying to essentially incentivize bringing back business to the U.S.
And one way, perhaps, for Congress to raise some funds to fund those extended tax cuts is raising the SALT. Well, actually, no, this would be the opposite, because keeping the SALT cap at 10,000 was a way to raise funds. But now there is discussion about raising it to 30,000. This is something that the lawmakers in New York, Connecticut, California, those high tax states have really been pushing for. How are you thinking about this in terms of the spoiler role that they could play here?
So we have to, when we're thinking about SALT, we do think that the GOP in these coastal states are gaining, traction. This is something that has never left the discourse since 2017, right, when this TCJA first went into act. The important thing here is that they could look for offsets on the corporate side. Again, one of the things I'm thinking markets are not anticipating yet is that this tax bill, while there's going to be a large framework and potential for TCJA individual tax cuts to get extended in full, the corporate side could have some puts and takes. And that's where you need to really focus as far as how are markets going to respond? What is the trickle-down economic impact from those potential tax changes?
What's your time frame for all of this to unfold?
So when I'm looking about this, I'm looking at Q1 through Q3 as sort of a volatility story as we continue to sort of sort through not just the tariff piece, but also the budget components. The reason why Q3 is sort of that end date is because they are looping in the debt ceiling vote. That is a drop dead date to force those lawmakers to make a decision and inject certainty into the markets. And then those of us that are holding cash on the sidelines or taking more conservative bets, can move back in. And, that'll be hopefully a positive for that Q4.
All right, Monica, really appreciate your joining us today. Monica Guerra is head of U.S. policy at Morgan Stanley Wealth Management. Let's turn now to the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Cardinal Robert Francis Prevost. He was elected as the head of the Catholic Church on the second day of voting in the Vatican. The 69-year-old Prevost was born in Chicago and became the first U.S. national ever to be elected pope. He has chosen the name Leo XIV. Next up is Bill Gates. The software billionaire says he has decided to give away his money faster than originally planned. His Gates Foundation will double its spending by giving away $200 billion over the next 20 years before shutting down permanently in 2045. And finally, Harvard professor Joseph Nye, the political scientist, became a leading scholar in international relations. He has passed away. He developed the idea of soft power, which is the ability to attract and persuade using the attractiveness of a country's culture, political ideals, and policies. Soft power, of course, standing in contrast to hard power, which is a country's ability to coerce, which has grown out of a country's military or economic might. Nye was 88 years old. This is Bloomberg. Apparently, it takes a lot to discourage homebuyers in New York. Contracts to purchase homes in Manhattan rose 41% in April from a year ago, despite all the stock market turmoil and concern over recession. That's according to appraiser Miller Samuel. Let's bring in someone with firsthand experience in this property market. Ryan Serhant is the founder and CEO of Serhant, a real estate brand that's achieved more than $10 billion in revenue in New York and other states. And Ryan joins us on set now. Great to see you.
Good to see you.
So April clearly started off with a lot of craziness, wild moves in the stock market. How did you see that impacting activity in the housing market here?
Well, nationally, April was a rough month, right? We saw 14% of all listings that went pending be canceled as soon as the tariff announcement came out. And then things bounced back really, really fast. There was definitely a V bounce. We saw closings increase 42% year over year, the luxury market moving incredibly quickly. listen, the past 2 years have been stuck in this interest rate, low inventory limbo. And so people are coming back into the market as long as rates continue to at least hold steady, not increase drastically. I mean, decreasing would be incredible, but if they hold steady, people are making decisions. They need to move.
They need to move. They've been holding off on doing so for a long time.
Correct.
And how much of it, I wonder, is sellers being more realistic with their pricing now than they were before?
Well, I mean, April 2 was such a unique month for us. We saw, 18% of all homes listed nationally reduce their price points. That was the biggest month of reductions that we've seen since 2016. We also saw inventory increase nationally in April by over 30%, which was the 18th month in a row that we've seen inventory increase. So we've got more inventory coming to market, especially as baby boomers finally start to come back to market, because they didn't during COVID. And 90% of everyone who has a home loan in the United States is still under 5%. The 30-year fix is sitting at around 6.7%. So people are finally saying, you know what? It is what it is. I have to make a move. So there's a lot of movement, which is setting us up for kind of a crazy end to Q2.
So I'm wondering how much of this is because we had a crazy April and people were scared and they needed to do something, or this is the start of the spring selling season, and this is typically when families and home sellers are thinking, okay, I got to make a move now.
There's a little bit of that. There's a little bit of people, spring sellers, fall buyers, falling back into trends. We saw that happen last year too. But remember, the beginning of last year as well, if I'm not mistaken, we had a little bit of a small bank crisis. And so people always have a reason to not pull the trigger. Consumer confidence is really, really important when we're selling any type of tangible good. But I think people are finally negotiable again. Right? 51% of all home sellers in the United States right now are willing to give some kind of concession. We haven't seen those numbers since 2019. And so buyers saying, you know what? It's too expensive for me to purchase. It's cheaper for me to buy new construction or to rent, especially in cities like New York City, than it is to buy a resale home. But I love this house. I'm going to offer you 10% off the asking. I want you to pay my taxes for a year. I want you to cover my move-in costs. I want all your furniture and your cat. Whatever it might be, deals are coming together because people are willing to have the conversation. That's my best advice to anyone looking to sell or buy right now. Have the conversation.
What does the conversation sound like when it comes to property taxes and home insurance? Because we've seen those premiums start to really spike. And so however much property prices have gone up, it's been offset by increasing costs to own that property.
Right.
To what extent is that holding back any kind of stabilization or recovery in the property market?
It hasn't yet because inventory is so low.
Okay.
We sell a significant amount around Florida, right? We have a major operation in Palm Beach, Miami. We just opened in Naples, Tampa, et cetera. And everyone asks us about home insurance and flood insurance. It's really, really hard to get big company flood insurance. Even Chubb pulled out of giving flood insurance in New York City. I had Chubb as a flood insurer in New York. We have hurricanes in New York now. They're not even insuring anybody anymore. So now you have to go private. Yeah. Private means if you flood, we'll give you some drywall, but we're going to leave it on the sidewalk. Best of luck. And so people are saying, you know what? I want to live on the ocean. It is what it is. Or I want to be within the floodplain. And they're willing to take that risk because inventory is so low.
Interesting. When the housing market was super hot, and I'm thinking in the years, after lockdown, everyone seemed to play this game where sellers would list their property for some lowball price, much lower than market value, so that when buyers start bidding, there would be this bidding war that would continue, and the final price would often be 20, 30, 40, 50% higher than the listing. To what extent is that still happening?
It's happening in pockets. It's not the standard now. But remember, again, nationally, housing prices have increased 50% since 2020. It's not normal. It's not normal. So we are giving back some of that, which is okay. Even if we give back half of the national gain from the past 5 years, we're still up 25% on equity for most homeowners. So in pockets, we still have bidding wars. We have them in New York City.
Yeah.
I have a client who just won a bidding war right now in New York City, and it was $14 million. So where there's premium inventory, where there's prime real estate, people still want the best of the best. In new construction towers we have right now, we are raising prices every 3 days to match demand. Mercedes-Benz places in Miami, a new tower we're doing in Brickell. We have price increase amendments consistently, and because people want quality, and that's what's moving.
What are you seeing in Los Angeles with the rebuilding effort slowly, moving very, very slowly here in parts along the coast and everything? I mean, if you want to talk about an inventory problem, there's a huge inventory problem in LA.
Yep, there is. What happened was incredibly tragic. But it's crazy if you go there now, no one talks about it. People have been displaced. They're still trying to look for housing. But Los Angeles is wide, right? Unlike Manhattan, if something were to tragically happen in Manhattan, you have to leave the city.
Yeah.
Los Angeles is very, very spread out.
Spread out, yeah.
And so people have found different places to move. There's different situations. We've even helped, through different hotlines and things we've had with helping people move. But you're right. I mean, inventory is tight and those lots are selling fast.
All right, Ryan Serhant, really appreciate your joining us today. Thank you so much.
Thank you.
Ryan is founder and CEO of Serhant. Still ahead on The Close, a conversation with Niki Leondakis. She is the CEO of CorePower Yoga, about how that company is holding up amid all this economic uncertainty. This is The Close. We've been hit with a tide of earnings, so let's get you a roundup of some of the notable movers and bring in Bloomberg's Isabel Lee, Natalia Knežević, and Alexandra Semenova. Isabel, let's start with you because you are watching Expedia.
Exactly, and it's not looking good. Shares are edging down by almost 8%. Expedia posted lower than expected gross bookings. This is a sign that domestic travel has started to soften even before U.S. tariffs roiled global markets. We have gross bookings across platforms for hotels, flights, car rentals, and vacation homes really missing estimates. So Expedia generates nearly 2/3 of its revenues from the U.S. This makes it really a good bellwether for just a general consumer sentiment and also domestic travel more broadly. We have its rivals, Airbnb and Booking, topping estimates for the first quarter, but reducing their guidance for the second quarter. They blame economic uncertainties and softer travel demand in the U.S. What are you looking at, Natalia?
I'm watching shares of DraftKings. So it is interesting that shares are up on post-market despite results came below expectations. Typically, first quarter is a really good time frame for sports betting companies because we have March Madness basketball tournament, we have Super Bowl, but this time around earnings missed expectations and it looks like it came lower because lower revenue from March Madness. Now, another key metrics, monthly users, unique payers revenue. It also came below expectations, down 5% on a year-over-year basis. And more importantly, the company lowered revenue guidance to the downside, and now it expects it would be somewhere between 6.2 and 6.4 billion. It is another reminder that while tariffs don't impact company directly, but this is also a signal that consumers could spend less on services from companies like DraftKings. Alex, what are you watching?
Hey, Natalia, disappointment across the board here for Coinbase. Total revenue, transaction revenue, subscription services revenue, all missing Wall Street estimates. The company also giving a second quarter forecast that missed expectations. That's sending shares here down about 3% in after hours trading. This comes after a 5% jump for the company during the trading day after it announced plans to acquire Deribit. That is the world's largest exchange for Bitcoin and Ether options. Of course, the stock got boosted by the fact that Bitcoin today rose above 100,000 for the first time since February. And it's no surprise that it's been a challenging quarter for Coinbase, given all the volatility in cryptocurrency markets. Coming into Thursday, shares were down about 20%. And it's also joining the companies that are warning about the outlook. The company said that macro uncertainty is impacting consumer sentiment. That could contribute to a softer crypto trading environment. And just a pulse check about how Wall Street is feeling about the stock. It's got 17 buys, 17 holds, and 3 sells going into this report.
All right. Thank you so much, Alexandra Semenova, Natalia Knežević, and Isabel Lee with our equity movers. Now, another company that did report today, Peloton, down almost 7% in regular trading after a third straight quarter of falling revenue. Sales from its bikes and treadmills tumbled 27%. Revenue from app subscriptions also lower. Peloton, of course, thrived during the pandemic, but has since struggled to break out of a slump post-lockdown. How are other fitness and wellness companies holding up then at this time of economic uncertainty? Let's check in with the CEO of CorePower Yoga.
And so far this year, it's just been an incredible rebound. And we're just incredibly excited about how much enthusiasm and increased interest in CorePower Yoga we've seen. Mm-hmm. We've got 24% more attendance this year than last year. And last year was a great year for us. We've had almost 500,000 brand new students and have had over 10 million student visits last year. So it's just in the face of the macro environment and some of the concerns consumers have, we're not seeing that downturn or pulling back that other industries are seeing, certainly at CorePower Yoga.
Are your consumers, or at least the types of consumers that are typical for CorePower, are they kind of at, I guess, an income level or a wealth level where they would be more insulated from economic conditions? Is that a worry at all? Do those types of people pull back from yoga and fitness classes?
Well, first of all, I'll say that, even people at, surprisingly high income levels pull back in times of economic uncertainty. Having other experiences with luxury brands, luxury experiences in past, careers, in economic downturns, or even when there's talk of it, people at high income levels tend to get trepidatious and just tighten the belt. But I think what's happening here is not all of our students are, so well off that they don't have concerns. I think people are prioritizing health, fitness, and wellness more today than ever before. And particularly with, younger generations, it's a much higher priority than other things. So they'll cut back on going out to restaurants or buying clothing before they'll cut back on their fitness and wellness.
Right. I hear what you're saying, but I wonder if they are cutting back in different ways, in that they might have been going to in-studio classes before, but they want to still have their workout, but perhaps downgrade to streaming their classes, which might provide more value for their dollar. What are you seeing in terms of people bracing themselves for a slower economic environment?
We aren't seeing that. We're not seeing that at all. Our growth year over year has been incredible, and we've had an incredibly strong first quarter on top of an incredibly strong first quarter in 2024. So we just, knock on wood, we haven't seen the effects of, what you would think would be impacting people's behavior given what's in the press and what's going on, in the external environment. And again, I really believe it's that people don't want to give up. It's not just the fitness and wellness. The reason we're not seeing the trade down to a digital at-home experience is the community aspect of CorePower Yoga is one of the most important, one of the top 3 things people come to CorePower Yoga for. There's nothing like being in a room with a group of other people and flowing in a yoga class, breath to movement, the synchronicity of that, the energy of that, the human connection. People came out of COVID craving that, and I think people value it today. So we're just not seeing the trade down.
That was Niki Leondakis. She is CEO of CorePower Yoga. Let's look ahead to what else we're watching for over the next 24 hours. Overnight, we're going to get data on China trade, those numbers coming out. And of course, we will break it for you here on Bloomberg News. And China's Xi Jinping is going to be meeting up with the Brazilian President Lula, and they will join Vladimir Putin of Russia to mark the 80th anniversary of the end of World War II. So Putin will be hosting both Xi and Lula. And also on the calendar, a lot of Fed speak. 8 different Fed speakers will be on the calendar, so we'll be looking to hear what they have to say. Kugler, Williams, Barkin, Goolsbee, Hammock, and Cook. And of course, we will bring you those details as they occur. In the meantime, another quick check here on stocks moving in the after hours. Pinterest and Lyft moving higher. Sweetgreen and Expedia coming down as they give disappointing full year guidance. This is The Close. Have a great evening.